How can you keep your investment income steady even when the stock market is falling? In this video, I'll show you how dividend stocks can help provide reliable cash flow, even during bear markets. When the market drops, it's natural to feel anxious. Many investors see their portfolio values shrink. The news can be unsettling, and it's easy to question your entire investing strategy. But what if there was a way to earn consistent income, even when prices are down? That's where dividend investing comes in. While no investment is completely risk-free, dividend stocks can offer a steadier source of passive income, especially during tough markets. Today, I'll break down how this works, share practical examples, and explain some key concepts in simple terms. Let's start by understanding why this topic matters for both new and experienced investors. First, bear markets, periods when stock prices fall by 20% or more, are a normal part of investing. They can last for months or even years. During these times, many companies see their share prices drop. Growth stocks, which rely on future earnings, can take especially hard hits. If your only plan is to sell investments to fund your lifestyle, you might be forced to sell at a loss. Dividend stocks offer a different approach. Instead of relying on selling shares, you get paid regular cash dividends just for holding the stock. This can provide a smoother ride through the rough patches, making it easier to stick to your plan. Let's dive into how dividend investing can help steady your income during bear markets. First, what exactly is a dividend? A dividend is a payment that companies make to their shareholders. Typically, these payments are made quarterly, but some are paid monthly or annually. Companies that pay dividends are often established businesses with consistent profits. Think of names like Coca-Cola, Procter & Gamble, or Johnson & Johnson. When you own dividend-paying stocks, you receive these cash payments just for holding the shares. You can choose to spend the dividends or reinvest them to buy more shares. Now let's talk about a few key terms you'll hear in dividend investing. The first is dividend yield ***. This is simply the annual dividend per share divided by the stock's price. For example, if a company pays $2 per year in dividends and the stock price is $40, the dividend yield is 5%. This helps you compare how much income different stocks provide. Another important term is the *** payout ratio, ***. This tells you what percentage of a company's earnings are paid out as dividends. If a company earns $4 per share and pays $2 in dividends, the payout ratio is 50%. A lower payout ratio can signal that the dividend is safer, since the company is keeping enough earnings to weather tough times. A third key idea is *** diversification. This means spreading your investments across different companies and industries. Diversification is important because even great companies can face unexpected challenges. By holding a mix of dividend stocks, you reduce the risk that any single company's trouble will threaten your income. Let's look at 3 ways dividend stocks can help steady your income in bear markets, with practical examples for each. First, dividend payments are often more stable than stock prices. During the 2008 financial crisis, stock prices fell sharply. The S&P 500 dropped by more than 50% from its peak, but many established dividend payers continued to send out dividends even as their share prices declined. For example, Procter & Gamble kept its dividend steady through the downturn and even increased it. While share prices can be volatile, companies with a track record of paying and growing dividends tend to prioritize these payments, especially if they have strong cash flow and a reasonable payout ratio. This means that even if your portfolio value drops in the short term, your dividend income can remain steady. Second, dividends can help you avoid selling at the worst times. Imagine you're relying on your investments for income. In a bear market, if your stocks don't pay dividends, you may have to sell shares to fund your needs. This can lock in losses and shrink your future earning power. With dividend stocks, you have the option to use the cash flow to cover expenses without selling shares when prices are low. For example, if you own 1,000 shares of a company paying $1 per share annually, you'll receive $1,000 each year, even if the stock price drops. This can help you ride out downturns without panic selling. Third, dividends can be reinvested to take advantage of lower prices. Bear markets aren't just about surviving. They can also offer opportunities. If you don't need the dividend income right away, you can reinvest your dividends to buy more shares, often at lower prices. This is called a dividend reinvestment plan, or DRIP. Over time, reinvesting dividends can compound your returns. For example, if you collected $500 in dividends during a market downturn and used that to buy additional shares at a discount, you'd own more shares when prices eventually recover. This helps grow your income and wealth over the long term. Now, let's touch on diversification in practice. It's tempting to chase the highest dividend yields, but that can be risky. Sometimes, a very high yield signals that investors expect the dividend to be cut. Instead, focus on companies with a history of steady or growing dividends, a sustainable payout ratio, and strong financials. For example, you might build a diversified dividend portfolio by choosing stocks from different sectors: consumer goods, utilities, healthcare, and even some real estate investment trusts, known as REITs. This mix helps protect your income if one sector runs into trouble. Some investors also use dividend-focused exchange-traded funds, or ETFs, to diversify even further. These funds hold dozens or even hundreds of dividend-paying stocks, making it easy to spread your risk. Before we wrap up, let's recap the key points. Dividend investing can provide steadier income during bear markets by delivering regular cash payments, even when share prices fall, reducing the need to sell investments at a loss, allowing you to reinvest dividends at lower prices for long-term growth, encouraging diversification, which helps protect your income stream. Remember, while dividends can help steady your income, they aren't guaranteed. Companies can cut or suspend dividends if they face financial trouble. That's why it's important to research each stock, pay attention to the payout ratio, and diversify across different sectors. And of course, this is not financial advice. Always do your own research or speak with a financial advisor before making any investment decisions. If you found this video helpful, please consider liking, subscribing, and leaving a comment below. Do you invest in dividend stocks? How have they helped you during market downturns? I'd love to hear your experience. Thanks for watching, and I'll see you in the next video.